We'll get going.
Alrighty, let's jump in. Friday, January 19th, to the Income Navigator Zoom session here. Igor, I'm going to let you kick it off.
All right. So first off, hello everybody. Welcome. Happy Friday. We're gonna go over a couple of things and what I specifically wanted to jump on and talk about. And I'm going to share my screen so that you're not just staring into empty space. Hang on one second. I'm going to share my option at Explorer. And please do let me know if you can see my screen here. And I'm going to look for my
I think we're good.
okay,
You got
perfect.
your one up.
Yep. So I'm gonna talk about my goals, what I am going to focus on in the Income Navigator, and how it's going to be slightly different from what I have been posting um, all of last year and prior to that. So for those that have been with us for some time and have been following trades that I post, you would see fairly large trades, 112s for the most part. I like to call these 1-1x bear traps because sometimes they go 1-1-2, they could be 1-1-3, they can be 2-3-5, whatever the case may be. And I think that the big SPX trades, for the most part, are they're not actionable for an average member of Income Navigator. Sure, the same trade could be taken using different underlyings, such as SPY, or you can use ES options, similar strikes, and so on. But I think that just that adds too many moving parts because members would have to convert strikes with ES to SPX or from SPX to XSP and or SPY, and it becomes a little hard to follow. So I do get that. I am going to continue to post trades that I do with SPX, and those are typically on Tuesdays. I open a 1-1-2 position somewhere around 52 days until expiration and so on. And then I post the trade in the Discord. Any adjustments, exits, anything, or any questions that are being asked pertaining to any of those trades that I do, each trade has its own post in the forum, and every question uh, gets an answer for the most part. And if I don't answer for whatever reason, you can tag me and um, post a link or whatever, or ask me in the main chat, and I'll address all the questions that you guys may have. So for those that have been following the SPX 112s on Tuesdays, I am going to continue to post those, and I hope that you continue to find this information useful. What I am going to add, or what I'm making a slight change to, is that I set up two other accounts. One is a smaller PM account, which with Thinkorswim is a minimum of $125,000 to qualify for portfolio margin. So the small, quote unquote, PM account is a $125,000 account with Thinkorswim. And within that account, I am going to do trades that are going to be a 1-1x structure. I'm going to use the an underlying that is 1/10 the size of SPX. The underlying is XSP. It's a very similar product to SPX as far as tax treatment goes. I think liquidity is just fine in the XSP. The only difference is that it is 1/10 the size of SPX. So if you wanted to trade SPX, but you can't do it because of the size, the solution is to use XSP. I think the notional is equivalent to SPY. As you can see on my screen here, I have a position that is expiring today. This is XSP, and you can see the strikes are, instead of 44.50, they're 445. So they're 1/10 the size of SPX. And also, I have set up another account where I am going to use span margin instead of portfolio margin, and that account is going to be used to make trades such as the 1-1X using ES, strangles, straddles, whatever else, and the underlyings are going to be either ES or gold, oil, whatever it may be. I'm not a big fan of trading the wheats and whatever else. But I think the primarily I will look at the S&P 500 futures options, and I am going to look at gold and oil. I think I'm going to stay away from natural gas and a few other things, not because they're not good. It's just not my cup of tea. Um, so those two accounts I'm going to run side by side. And for right now, my allocation is the following. So I have about $125,000 with the PM account with TOS, where I'm going to use XSP for my 1-1X structure trades. And then I have a $50,000 account with the Thinkorswim that I'm going to use for 1-1X or strangles with ES, CL, and GC, and maybe something else. The reason why I chose TOS is because with the 1-1X structure, the Thinkorswim allows me to send the order as one order. I don't have to break the put debit spread away from the naked option. So that kind of makes things a little bit easier. But I think that, if you are trading on Tasty Trade, they are a fine broker. The commissions are fine. I don't think that TOS has better fills and whatnot. So don't take this information the wrong way. Use whatever broker works best for you. Me, for 1-1X trades, I am going to use Thinkorswim for my options on futures. A couple of questions here. I see that do we still trade broken wing butterflies, diagonals, and others? That's probably more, if these are directional trades, that's probably more towards things that we do within the active trader. How are the spreads and the liquidity in XSP? This is a good question, and this question does come up quite often. People do look at open interest, which is an indicator of how liquid certain options may be. Uh, with XSP, we do not have as much volume or as much open interest as we do with SPY or SPX. However, S&P 500 options, or S&P 500 as an instrument or as a vehicle, is very liquid, meaning that if I'm trying to put a trade on in XSP, I know that whatever trade I'm doing, I have the market maker on the other end, and their job is not to sit there and find the most advantageous point in time where they choose to take my trade. Their job is to connect the buyers and the sellers, and very often they are the other side of our trades, which means that when they take the other side of our trades, if we're selling premium, that means we're taking on the money, right? And the risk is being transferred here. So now the market maker has the risk, right? Which is the opposite of the risk we just took. And for them to offset their risk, they can just use the futures. They can use SPY. They can use SPX. In other words, whatever risk they take from us, they won't have a problem transferring that risk and hedging themselves out where they don't have any directional exposure. So it's not like we're trying to trade some four-letter ticker symbol that has no interest from the market participants, and the market maker now has to take the other side of our trade, and then he has to worry about how is he going to unload his risk. When it comes to S&P 500, we put the trade on, they took the other side, they need to unload their risk. They can just hedge their risk using other S&P 500 vehicles, and that's just how it goes. So as far as the spreads are decent. Liquidity is fairly decent. I haven't really had any issues getting fills with XSP. I know everybody wants to get an insta fill, but remember, sometimes if you put an order out there and you get an instant fill, that means you did not get maybe as good a fill as you would have if you bargain a little bit. But just in general, I don't think that fills are a problem using XSP. Um, I'm going to come back to questions here, and Tom or Candy, if you are on the call, if could keep an eye on, and then we'll come back to the questions in just a little bit. So I want to also show you guys, I do have a spreadsheet. It's not fancy, it's nothing special, but it works for me, right? And I always say, I do see questions. Tom did a great job, created a very useful tool for everybody to use. And I do see a lot of people have questions, especially those that may not be familiar how to use spreadsheets. So they have questions and maybe struggling a little bit and how to use this spreadsheet for their own trading. And I think the solution is, guys, everybody, um, build something like you can take Tom's spreadsheet and you can take it apart. I guess you can, strip parts of the formulas that may be in that spreadsheet, but build your own spreadsheet. Use that spreadsheet as kind of a guideline or but you in the end, right, you want to end up with a tool that works for you. So what I do is I start very basic spreadsheet, right? And the information that I want to see is very basic. And then as I continue to add data to this spreadsheet, then I start to add different functions to it and try to pull information that is useful for me. So I'm going to share the screen where I have my spreadsheet, and just going to show you um, what's on the spreadsheet and how I use it. And once this spreadsheet is at least a couple of months old, where there's enough data on it, I am going to share a template with all of you guys so that you can hopefully use this for your own trading. I'm going to switch screens. Please let me know if you do see a spreadsheet on your screen now.
Yep, all good.
Alrighty, so this spreadsheet is actually based on, I don't know if you guys know, I forget the guy's name is Ben something. He's the creator of the Wingman or one of the other tools that people use to track their options trading.
I
So
think Ben Latz, I think, was his name.
yes.
Yeah.
Some years ago, right? This is before the Wingman started. He created this spreadsheet that was just a lot of automation, which is great. And I took some of the parts of that spreadsheet and added some of my own things. You could probably see that this is familiar for those that look at information that I post on Discord. So here I have different tabs. So this is for 2024. I just started to use this. So the dashboard is kind of half dead right now because there's just not a lot of data. But here I'm going to have a trade summary that's going to show my realized results for the trades that I do in both the small PM account and the span margin account. It's going to calculate returns. It's going to calculate my win rate. It has a few other data points. It's going to show a chart of my returns. And then here, it's going to show a breakdown count of strategies. It's going to show me my P&L distribution. And I think I'm going to add some more information as things continue to develop. Like, I say to myself, what would I want to see on the dashboard, right? Maybe I want to see number of positions. Maybe I want to see how much total buying power is currently being used up, or what the percentage of my total net lick is being used in any trades that are currently open. Maybe some more information. I'm just not really sure just yet, but every spreadsheet has to be kind of an ongoing project, right? You have to keep on adding things, and maybe you need to change things around. Again, you need to work within your spreadsheet that's going to give you information that you need. And then here I have different tabs. So here I'm going to keep track of all of the PM trades that I do, and these are primarily only going to be XSP. So within the small PM account, I am going to do two things. It's going to be a 1-1X trades using XSP, and then I use all of the available buying power to buy T-bills, and I rolled them from 13 to 26 weeks. So I have 13 and 26 weeks in rotation, and we can talk about T-bills at some point on next call or sometime in the near future. So the SPY campaign is in the big portfolio margin account, so that's not going to show up anywhere here, and it's kind of I don't think that this is the reason why I'm doing this, and I'm going to touch on the reason why I'm doing this. The other tab is TD span, right? So this is the span margin. I'm going to keep track of right now. I just have this is 1, 2, 3, 4. I have 5 trades, and then here I'll have a summary. The 1-1X trades using ES. I think I still have another ES trade that is currently in the Tasty Trade account, but once that rolls off, I'm not going to use Tasty Trade account for this purpose. And I'm going to try to keep everything in this one spreadsheet. So when it comes to like, for example, this is a trade that I took earlier today. I have the trade ID. So if anybody, looks at a spreadsheet and wants to, go back and kind of look at the details of any trade, there's a trade ID. And then if you go on Discord and if you go into the trade alert section, you can use the search bar to punch in trade ID, and that trade should populate in that search result, and you will be able to see where the trade started, any comments that were made, any adjustments that were made, any questions and answers pertaining to that specific trade. So I have a date when the trade was opened. Obviously, it hasn't been closed. Ticker symbol. So I have a small list of tickers that I'm going to use. This is an ES trade. The size of the trade, expiration, what strikes, what strategy. There's a different bunch of strategies that I may be using at some point in the future, but for right now, I'm going to focus on 1-1-2s, maybe 1-1-1s, or if it's some sort of a ratio, but it's always going to be 1-1X. Then I have a column that tells me, so I took the trade today. Today is 119 days away from expiration. Next column tells me how many days I have been in the trade. Entry is my what was the price. This is the credit that I collected, $10.25. Then when I exit, I'm going to figure out all of if I made adjustments and they were debits, or if I made adjustments they were credits. I'm going to kind of put together within this spreadsheet somewhere. I'm going to put together a calculator to figure out exactly what my exit price was. Once I punch that in, it's going to automatically figure out my P&L. It's going to keep track of my running P&L, meaning adding all of the trades that have been closed out and continue to add to the running P&L column. And then reason for exits, there are only a couple of reasons. Trade either expires, gets stopped out, or exit before the expiration, which is an early exit. And then here I have a few columns that kind of help me track things. So this is telling me how many days to go, right? So this trade was put on today, 119 DTE. There's 119 days to go. Trade that I took back in December, which is currently open, was taken when it was 88 DTE. I've been in the trade for 32 days, and there are 56 days to go. Also here, I make a note of what was the starting buying power for when I took the trade. So if this trade, for example, gets into trouble, if market's pushing lower, and now the margin is X, whatever it may be, the reason why I use starting buying power, I am very curious to see the effect of buying power in a down market, right? And then I also run side by side in my small PM account. I have trades that are similar. They're a little bit bigger in size, but that's because the notional value of the contracts are different. But they're kind of similar, right? So I have a trade that I took here, 17th May, right? This trade has 119 days. So this is XSP. I did 10 contracts, and um, the starting buying power is 100. It was $15,500 or so. And what I'm curious to see is if the market is pushing lower and or volatility is rising, I want to see the effect of buying power in a down market. Because at this point in time, we just haven't really seen much of a down move or enough volatility expansion to get a good idea of how buying power will react to different market action. And I think that at some point in the future, if my findings are that using ES for 112s is more advantageous than it is to use XSP in the PM account, I will allocate and I move away from using PM account for 112s, and I will focus and concentrate on doing 1-1X trades using ES options in a span instead of PM margin account. I hope that makes sense. I think that um, the real benefit of using portfolio margin is for trades that are kind of like 1-1-2s, but they're way out of the money, and the goal there is a little bit different. Maybe at some point in the future, we can do a session where we can talk about some other strategies that are specifically, um, uh, I guess their PM gives them a little bit more advantage. And these are strategies where you sell options naked that are like 25% out of the money for just pennies, right? Um, for this account, so we have two things going on. We have span and we have a PM. At some point in the future, it could be 3 months, it could be 6 months from now, I'm going to look at the results, and the results are going to dictate where. Sorry, my son. Kids are home today from school, so my son is here running around making a little noise. So at some point in the future, I'm going to look back at the results, and I am going to decide where most capital is going to go to. Let's just move forward to look at, so net lick here, I'm going to put in every couple of days. I mean, I can do it every day. Just put the net lick for both PM and span margin, and then these numbers will reflect on the dashboard just to kind of show me my cumulative returns for the year. Then monthly returns here, this thing is going to calculate performance of S&P or SPY versus my portfolio to see who's doing better. Even though I think that metric is kind of useless because, again, I'm not competing with S&P 500. I'm competing with myself. If I am beating S&P 500, that's a bonus. But for the most part, I need to try to meet my goals and my needs with my trading. Close trades here, so like, for example, we have one trade that's going out today that is XSP that I was on the screen a little bit earlier today. So exit date would be today. It's expiring in the tail, so we get the tail profit. The strategy is 112, and the profit there with 5 contracts is $310. And the next tab is going to look at the closed trades and then give me a report where it's going to show me all the ticker symbols that I'm trading, all the strategies that I'm trading, and it's going to give me the totals. So then 6 months from now or 3 months, it's going to be an ongoing process. But at some point in the future, and I'm going to revisit this every so often, maybe once a month, maybe once a quarter or so on, and I'm going to look at my results, right? Is XSP is what I'm doing with XSP. If I'm allocating 3 times as much money to trading XSP, but it's not giving me 3 times as much return or results as, for example, ES, then I know that I need to make some changes within my trading, right? Because just like you guys, I'm in the same boat. I look at my results, and my results dictate what I need to do as far as making changes to my trading. So that's, there's really nothing to look at just yet. We'll have more information, and this is going to be a very useful part of this spreadsheet. Then we have the benchmark. This is where information gets pulled for SPY to populate into monthly returns. Settings, that's nothing there. And then um, data validation. This is just where information gets pulled into these the ticker, the strategy, status, and the reason for the close. So this spreadsheet is still very young, so to speak. I just started it. I keep adding and I keep changing things, and I'm no expert in spreadsheet by any means. Um, so, it's not as fancy as I want it to be. And at some point, as I keep adding things to it, if I do run into some issues, I do know that we have a few threads going around where people are sharing um, formulas and how-tos when it comes to spreadsheets. So I think that's going to be very useful for me as well. And I may ask questions and reach out for maybe some help at some point in the future. So that's as far as this spreadsheet and the goal for the two accounts that I'm running side by side. I know we had a number of discussions where, we assume that portfolio margin is a little more buying power friendly. And I do believe that buying power, maybe initial buying power is not as friendly as ES because span margin trading is a little more leveraged, which is a risk in itself, right? Using more leverage requires less money to put the trade on. That means that the money that you're kind of saving or you're not spending, right? Because buying power is so low to put a trade on, you use it elsewhere. But when the storm hits, you could you can really run out of buying power because you spread yourself too thin. You put on too many positions, not necessarily too big a size. You put on too many positions because each position took up so little buying power. So when the storm hits, you could find yourself in a really tough spot because you didn't realize that you're taking on all these positions and you're not leaving yourself enough buying power for when the market um, goes down and volatility rises, if that's ever going to happen again. Um, what else? So that's that. We'll see if, and again, the data is going to dictate which one is better. Is it PM? Is it span? We can go back and forth and talk about it for hours, but I think the data is what's going to actually confirm our suspicions, and the decisions will be made based on what the data is telling us. I'm going to switch back to Option Explorer. I'll just real quickly go through positions that I am holding in the PM account as well as the SPAN account. So this trade is going out today. It's going to expire January 19th. We took the trade 63 days ago. Market moved almost 2 standard deviations higher from where we took the trade. Obviously, this is the reason why we are expiring in the tail. Whatever we collected, $310 up front, that is what we're going to keep. All options there are still, all of the options that are part of this trade are all out of the money and will be worth nothing at the close today. The next trade is expiring 12 days from now. I have harvested the short out of the money puts. We put this trade on 49 days ago. The market has moved 1.3 standard deviations higher, right? We're in a pretty strong uptrend still. And all I did was a couple of days ago, I went ahead and I closed out the naked short puts. This left me with a put debit spread that is very likely to expire worthless unless over the next 12 weeks we see a move to the downside to the tune of about 7% or so. It's very unlikely, but there is a chance. And for right now, having this put debit spread with 12 days to go, this does relieve some of the buying power. Not much, but it does help and serves as a hedge for some of the other trades. What are some of the other trades? So, for example, we have a trade that is expiring on March 15th, and this is what this trade looks like. We can see that if the market moves down 7%, right, our P&L is going to be at a draw of about, in this trade, will be down about $500. But in the same time, if that happens in the next within the next 12 days, right? If that is the case, and we move down 7%, instead of being down 500%, this trade is actually going to be up about $1,000. So that leftover put debit spread is going to kick in and partially save this trade that expires in on March 15th, which is 56 days out. So the leftover put debit spread 12 days out is not going to save the whole thing. I still need to manage each and every single one of these trades. And on my spreadsheet, I do put down, what is my planned um, max allowable loss for every position. So, for example, in this trade, I think that my max allowable loss for this trade is somewhere around 6,000. So, if I'm down 6K in this trade at any given time, it's time to get out. But until we get there, on the way down to that minus $6,000, if the market was to pull back about 7%, it's just going to help me a little bit because the leftover put debit spread is going to kick in and partially help offset some of the losses for this trade. Then I have March 28th, and these trades, this trade was taken 15 days ago. Market moved about just over one standard deviation higher. For those that have been trading 112s, 11X, 11 anything, probably noticed that in the low volatility environment, these trades act a little weird because volatility gets hammered on our long put debit spread while our short naked options kind of just sit there and do nothing. So a lot of times the market's moving higher, volatility is falling. We would assume that this trade would be a lot more profitable than what it is, but it isn't because the value of our long put debit spread is actually decreasing while out of the money puts, they're just too far out and they're not decaying as fast, or they're not getting hit as hard as options that are closer at the money. So during these weird times of strong, persistent market move to the upside, we do experience this weirdness where it's almost like it's almost the same effect as if volatility is rising, right? Because if we just look at this trade, for example, we take volatility up a couple of points, you can see our T+0 line gets pushed down. So that's essentially what's happening right now. When volatility is low, our long options are getting hit harder than our short options, and that creates the net positive volatility effect. I hope that makes sense. But anyways, this trade is far from being in trouble. If things continue, this trade has 69 days to go, and one of three possible outcomes here is we expire in the tail, in the trap, or we get stopped out. And for this trade, I think my stop loss is minus 3K. So at any time, my process is, okay, let's look at this trade. Am I down 3,000? No, I do not need to do anything. Right. So just kind of let it work. Don't look for trouble. Trouble will find you. Then I have April 19th. This one is 91 days away. You can see that the market moved one standard deviation higher in 10 days, and the trade is showing a slight loss. Why? Because the options that we sold naked didn't lose a whole lot of value, but the long put debit spread took a hit. So that's creating a net positive volatility effect. And this trade is Vega negative, and that is why we're not really seeing what we should be seeing as the market moves higher and volatility is decreasing. You can see that IV changes minus about 1.75%. Anyways, we do not need to do anything about it. I think that it's going to work out itself. It's just going to take a little bit of time. Then I have April 30th. Same thing. 7 days in the trade, market moved 0.7 standard deviations higher. Volatility has risen just a little bit. I'm not sure where that came from. And this trade is now showing a break even. So we haven't really made anything. We haven't lost anything. This trade needs nothing. And the next one, we just took it a couple of days ago. The market has moved almost 1.5 standard deviations to the upside. we're still far away from being in trouble in this trade. We don't really get into trouble until, maybe 450 or 4,500 on the S&P. Until then, do nothing. Just let this trade cook and find something to do to stay away from getting yourself into trouble. So these are the trades that are a part. Hang on one second, guys. All right, I'm back. Sorry about that. My son came in here um, with a whole setup. He was ready to play some music here, but anyways, so these are the trades in the PM account. I'm gonna just quickly go over a few positions that I have on in the span margin account. And again, some of these trades are very similar. They kind of look alike, and that's totally fine. My goal is to monitor and to see how these trades will react to different price action or different market movements. So this is a trade that I'm holding with 56 days to go. It's been open for 32 days. The market moved about a half of one standard deviation, so nothing major has happened. It's kind of sitting at the tail profit. And as you can see that T plus zero line starts to dip on the way up. It should not happen, but it does because, again, put debit spreads are getting hit harder than out of the money naked options, right? These options have already lost, a big chunk of their value, and now put debit spreads are getting hit, and that's why sometimes we are seeing this weirdness when the market continues to rise, but our 112s are either losing value or they're showing no progress. With this trade, it probably makes sense to. I think I made an adjustment. Yes, I did. So what I did was here at some point. This was on the January 10th. I rolled my long leg of the put debit spread closer to the short leg, so I shrunk the size of the trap, and then I closed out one of the short naked puts. Um, Again, this trade, right? The way I look at it, so for example, if my stop in this trade is minus 3K, am I down 3K? No, do nothing, right? If we're starting to move into the trap and starting to, depending on how fast or how much time we have left on the clock, maybe some adjustments may be needed. I look at delta hedging just to kind of uh, push my stop loss a little bit further away and or maybe delay it a little bit. But in any case, regardless of any adjustments that I may do, if I'm down $3,000 in this trade, that means that um, it's time to close out the trade and not look for ways to get myself into more trouble. So that's March 15th, March 28th, 112, also in ES. 22 days in the trade. We kind of didn't really go anywhere. So we're just sitting here. And 69 days to go. It's just going to um, play out. If we still where we are right now, we'll just capture tail profit and nothing else is needed. This is April 19th with 91 days to go. Again, 17 days in the trade. We moved just over half of one standard deviation. Nothing really is happening. So I'm just going to let it simmer. And DK is kind of slow, and that's totally fine. But eventually, this trade is going to work out. As long as we're not down to where I have to stop this trade out, I don't really care which way the market goes. Just got to wait for the time to get burnt off the clock. This is a trade that we took 2 days ago. The market, not sure if this information is accurate. Did we really move 2.3 standard deviations from 2 days ago? Maybe we did. Yeah, we probably did. So if I took this trade when we were testing the rising 21 EMA on ES, we are now 2.32 standard deviations higher. we would expect to see this trade a lot more profitable than it is currently, but it isn't for the reasons we already mentioned several times. And again, it is what it is. We can't control the price. We just need to wait for time to pass, and eventually, if we're somewhere above 47.50, we'll make tail profit. If we're inside the trap, we're going to get a nice bonus. And if we are hitting our stop, in this case, this trade has a stop loss at a loss of about $3,000. So as long as we're now down 3 grand, doesn't matter if we're inside the trap or outside the trap, it's do nothing, just wait. And the last trade, this is a trade that I took earlier today. This is May 17th. And very similar. Again, this might sound very repetitive. It's very boring, but this is what we do. We're not looking for excitement. We're not looking to, sit in front of the screen and watch the market tick by tick. These are the kind of trades that allow you to walk away and kind of focus and enjoy on other things that you may have going on in your life, family, kids, your dog, whatever. So these are the trades that I'm going to focus on. 2 accounts, PM account, and then for both accounts, like right now, right? I do not have a written plan where I say, hey, every Thursday I'm going to put on a trade. Every Tuesday I'm going to put on a trade. The only thing that I do is the SPX campaign style 52 DTE 112s that I do. But for these 2 accounts, for the small PM account and for the span margin account, what I'm going to do is I'm going to let my buying power dictate when I take the trades. Like, for example, right now I'm probably using about 26,000 out of 50,000 in the span margin account. So I'm about 50% buying power used up. And this is after today's trade. If I want to go a little bit higher, I can. It's for me to decide whether or not do I want to. Like, I don't want the delta to net lick telling me when to put trades. I know that we do use that metric to kind of look at how does your theta compares to your delta to your net lick. That's not a driving force for me. For me, it's more like, all right, I'm going to look at all of my positions and see that I have a net positive delta. What's market doing? Okay, market looks bullish. Okay, do I want to put on another trade and add a trade that has more positive delta? Sure, why not? Right. If I think the market's getting a little overextended, if I have the buying power, maybe I'll put on a new trade, except, taking on positive delta, I'll structure the trade in a way that's going to be a little more delta neutral. So instead of doing maybe 112, I'll do a 111. Or maybe I'll push my 2 naked puts way far out of the money, right? And make my trade less delta positive in the beginning. So I'm going to let 2 things, my near-term market outlook and my buying power available, that's going to dictate when and what kind of trades I'm going to take. I'm going to summarize based on my findings, and at some point, I'm going to outline trades that I have been using. I'm going to share it with everybody so that, if you wanted to kind of, take my information and use it for your own trading and kind of build your own toolbox of trades that are available to us. Again, 112s, as we have mentioned this before, very flexible, very dynamic. You could structure 112 in the bullish, in the neutral, in the bearish way, in any way you can. You can also add a few extra things to 112 to make it kind of a hedged. We had a couple of good discussions earlier today about introducing few other variations of 11X. So that's going to be really exciting. And that's pretty much it. I mean, I think I covered everything that I wanted to say to you guys. If we have a few questions over the next couple of minutes, let's tackle those, and we'll get everybody on their way. Or if Tom or anybody else wants to take over and um, answer some more questions. We are here to help, guys.
Yep. So if anybody's got any questions either on this or anything else that we've been covering, you got an opportunity here to drop it in chat and we'll see what we can do to answer questions for you.
So somebody said earlier today that PM should benefit trading different underlyings. I do agree. I don't think, SPX is just let's think about it. It's a $4,800 instrument times 100. The notional value of SPX is it's huge. And Tom said this a number of times that unless you're trading a $500,000 account or more, can't really trade 11X using SPX options. And maybe a standard 112 is not the best for PM accounts, especially in the low volatility environments, because portfolio margin account, right? The way they assess the risk, right? And they look at two price slices, minus 15% and plus 15%. And if we're just using S&P, I'm not going to talk about, beta weighting your entire portfolio to S&P and then try to figure out what your risk is. But if you just look at SPX, let's say you're trading 112s in SPX, and if you set up a trade, a 112 using SPX options, and then you set your price slices, right? And I'm referring to the Thinkorswim Analyze tab. If you set your price slices to minus 15%, right? And you look at your buying power requirement at minus 15%, that is what your broker wants you to put up. And now think about this. If the volatility is low or relatively low, like what we're seeing right now, where you're, you know, placing your two naked puts, maybe 13% out of the money, maybe 11% out of the, depending on how much time, right? If you look at like a standard, I don't know, maybe 56 DTE, your naked puts are probably, 13% out of the money. And that makes PM account buying power requirement absolutely through the roof. Relatively speaking, if you were to compare the same exact trade setup when the VIX or volatility is, let's say, not at 14 or 13 or wherever it may be right now, but rather at 19 or 20, and you're placing your naked puts maybe 23% out of the money, your buying power requirement would be a lot lower when volatility is higher. So this is kind of a risk management or a kind of a built-in risk management metric that during the times of low implied volatility, the broker will not allow you to go heavy in size on trades like 112 because they will ask you to put up way more buying power than if you were to set up the same exact trade, but during higher volatility environment. I hope that makes sense. And I do appreciate portfolio margin for that specific reason, is that when volatility is low, because they will automatically ask you to put up more money, that will keep you away from getting into trouble. Because as I said earlier, with ES and a low initial buying power requirement, it's very easy to blindly put on too many trades, right? You took a trade in ES. Now you want to take a trade in CL. Now you want to take a trade in this and that. And before you know it, okay, you spend the money well, so to speak, right? You're not concentrated in any one specific position, but now you have too many positions. And when volatility spikes, you're out of buying power because, again, too many positions on, very little buying power to put the trade on because of the leverage that span margin offers. So you have to be very, very careful about that. I do think, and I used to do this a lot with portfolio margin, where I would sell way, way, way out of the money puts in Tesla when Tesla was 3,000 plus, in Apple when Apple was Remember when Apple was over $1,000 a share? Amazon was over $3,000 a share. I would sell not necessarily nickels, but I would sell options for 20 cents and 30 cents. And those were, like 4 or 5 plus standard deviations from week to week. And that's where portfolio margin was extremely, extremely helpful. For a standard 112s, you really just need to have a big enough account to make it worthwhile. And again, I'm very excited to see how span compares to portfolio margin using XSP versus ES, and we're going to draw some conclusions at some point in the near future.
And we've been talking about it a bit too. I mean, you've really got to plan out what your strategies are, what you want to do, and then determine if you have a sizable account that's over 150. Yes, I know it's 125 on Tasty, but
Mm-hmm.
you're over 150. Is it really worthwhile to go to PM to trade certain types of strategies? And is there an underlying that you can move to that makes sense? And for the most part, it's very difficult. Even though they give you PM to trade what we're doing, in a PM account that's not sizable. And I think we've been throwing out, between Igor and I, somewhere between 1 and 1.2 million as a good size to start to look at PM if you're going to trade these types of trades. And now Igor can do this in a smaller account, but he's not doing a whole lot of anything else, and he's using a different underlying. He's not using SPX here either. So just make sure you know what your underlying is, what your strategies are, and just because you can use PM doesn't mean you should. And PM and futures don't always mix well, because futures uses up cash, which will not count towards your equity. So if you've got a PM account at $200,000 PM account, but you have $100,000 worth of futures in that account, technically you would subtract that $100,000 of futures because it doesn't count towards your equity, and now you only have $100,000 left in that account. You're no longer meeting the minimum PM requirements of 125 or 150 or whatever your broker is asking, so you're going to get a margin call. So mixing the two is not always great until you get big enough where you've got a mix of futures and a mix of other equities in there that isn't going to cause you a problem. Because once you use once you're buying futures or selling futures, trading futures, you're using up your cash balance, and you can't use it ever again till you're out of those trades. So once you've got trades on, it continues to just suck that cash balance down, and it's not helping your PM balance. So you may find that if you try to mix them and your account's not large enough, you're going to have problems. So something to consider, which for me is why I downgraded from PM back to Reg T, because it was actually counterproductive to trade futures in a PM account.
And that totally makes sense. I mean, I think everyone should keep track of all of your trades, keep track of all of your results, and then let the data dictate whether or not you should continue using ES. Maybe ES is too big a contract for you. Maybe, using span margin is the right thing, but maybe, you need to move away from certain underlyings. And again, the spreadsheet that I am going to share, once it has more information on it, is going to help me visualize to see what tickers get the best results where, and then I'm just going to, focus on, what I have been doing for years, and, just kind of going from trading 50 different underlyings to trading 30 underlyings. And then depending on those 30, I may go down to 20. And then at some point, it's just going to be a handful of underlyings. And even right now, majority of my trades are within the S&P 500. I don't need to chase. Yes, sure. I like to trade the Apples and the Amazons and Teslas and whatnot. But the main 112 trade is in the S&P 500. It has all the things that I need: liquidity, it has the size, it has whatever, and tax treatment if we're talking about SPX or ES. And that's all I really need. Do I need to chase the next shiny thing? I don't. I just want to find something that works, and I'm going to try to perfect it and try to make it better and try to see if there's anything I can do to make it better going forward. But you need to have information in order to tell you what needs improvements. And just like Tom realized that maybe using PM for his purposes wasn't the best, so he made a change. And at some point in the future, maybe he decides to, for whatever reason, say, "Hey, now I'm going to utilize PM," and that's what he's going to do. And good, we always have to change, and we always have to try to improve and get better as we continue to move on our journeys.
Yep. And so it's important to realize what you're trading. And again, I'll make the last comment on this, is that just because you can use PM doesn't mean you should. So just because you have a $150,000 or $125,000 account, depending on your broker, doesn't mean you should flick the PM as soon as possible. And I think Igor and I talked, I think this was 3 years ago, or I don't know. Igor mentioned it. One of the best uses of PM, in my opinion, and he mentioned it here too, is to trade really far out of the money. If you sell far out of the money options, PM is an awesome tool. We even talked, bandied about the idea of just a fund that did what, like 2 delta SPX.
All tail risk.
Trades, and just starting a fund that's all we did, because you can use the leverage of PM to make a really, really good market beating return on a pretty simple trade. That's why also the SPY leaps or those SPY weekly puts, and those are great in a PM account, because again, you're getting pretty far out of the money. I mean, and even a 14 or 12 delta is not, it's pretty far out of the money, but you can go lower. You can have a pretty good portfolio built if you want to monkey around with it with PM. If you don't want to fuss with other things, and you don't want to try to hit 20%, to 30% a year. If you're pretty comfortable in that 15 to 18% a year margin, you don't have to get too risky with a whole lot of what you're doing. You can get pretty far out of the money on SPX and SPY, and throw on either 90 DTE or 365 DTE trades, and get pretty doggone far out of the money and use it differently. The problem you have is, if you're trying to hit 3% a month, you're not going to do it there. So what is your goal? But when you have a $2 million or a $1 million account, well, do you still need 30%? I mean, sure, it would be nice. But are you okay with 15% a year on a $1 million account, and have almost no real risk, no tail risk on what you're doing? So it really have to decide what you're doing. When I have a larger account as well, that's over $1 million, and that I don't try to get 3% in there. So I'm 1.5% to 2%. Much safer, much easier trades, not as many trades, more boring. Okay, it's risk level that I don't want to lose. Okay, I'm okay, and I think I mentioned this the other day. I'm okay losing a 15, 20, 30,000. You may not. I'm okay doing that. I'm okay losing a $50,000 or $100,000 account. I can take a little bit more risk on it, because I pretty much have the conviction that if I lose a chunk, I'm going to get it back. Okay? But as you get older, okay, if you're in your 30s and 40s here, you can make that back. If you're starting to get into your late 50s and 60s, okay, now losing a good chunk of an account, 30% of an account, not really what you want to do when it's at $1 million. Now, so you've really got to figure out what's best for you, and move from there.
I think that I brought this to somebody. I forget what we were talking about, but the the comparison was if you can make if you can make um, if you can make 50% on $100,000 account or make 10% with a $600,000 account, which one would you rather do?
Mhm.
Right. So you could say, well, of course it's going to be 50%, but do you really? Right. 50% of a $100,000 account is 50 grand. 10% of a $600,000 account is 60 grand. So 10% isn't appealing, but in dollars, you'll make more. So as your account grows, you want to take less and less risk. And by taking less risk, I mean, if you're going to make 10%, you're probably not going to take, trades that could potentially put you down, I don't know, 40 or 50% for the year, because then just, your risk reward doesn't align. So the bigger the account, the less P&L volatility you want in your account. So as Tom says, with a $2 million account, if you're targeting 3% a year, 3% a month, or 36%, how would you, how would you take it if your $2 million account was down 40%, at some point? If that doesn't sit well with you, then targeting 3% a month is not, you're taking way too much risk. You just kind of looking at the reward without thinking about the risk. And that's, you should always think about risk before the reward. Like I always say that, if you take care of the risk, the profits are going to take care of themselves.
Fraz, I'm going to answer your question real quick in here too.
Guys, I have to jump on another meeting.
Yep.
So if you have any questions, you put them in the chat. We'll
I'll
answer
stick for a bit
all in
too.
chat, and I'll talk to you guys later. Have a good weekend.
Thanks, Igor. Super helpful.
Problem.
So really, really good stuff there. And so looking at CL here, Raz, just taking a look at your trade. So you're trying to set up a CL112 to match the setup guide. Well, I'm not sure what in the setup guide you're not getting. So I set this up. If I was doing this trade on oil today, sure, I would go out to 56 days, exactly what you did. I would start around 25 delta. It doesn't mean that's where I'll end up, but I'll start there and I'll go about one wide on CL. So that's, I think, pretty acceptable. And then I would go down to about 5 delta-ish or something, 35. And when you take a look at this trade, here's what you end up with. So I guess my question is on this particular trade, what's not matching up? So when I look at this trade, I'm getting $350 here, and I'm using 5,097 in buying power down here. So this is a 6.8% trade in 56 days. So it certainly, to me, matches the criteria I think that you want in a trade. It's over 3% a month on my buying power, which is always kind of my minimum piece here. So if you want to type in chat what's not working, it seems like a pretty good setup for me. And I'd look at a similar trade like this, and I don't know if Craig was commenting on this particular oil trade or another trade, but yeah, I think it looks fine. If my minimum on this thing is I want to get it somewhere around that 3%. So the updated spreadsheet on the dashboard has different criteria for CL112s. All right, so I'm going to share my piece here. So if I look at the 112 here, roughly I'm taking about $400 on $4,300 in buying power on average. Well, this trades 350 on 5,000, so it's not far off. Okay, so I'm taking it 350 on 5,000. So I feel I'm pretty close. 350 instead of 400 and 5,000 versus 4,300 on this. It seems to be right on the money. So when I'm looking at this thing, it's fitting exactly in here what I would be looking to do. And if I was putting this on, depending on how many trades, I can go up to 3 contracts a month or something on this particular trade. So to me, it fits everything that I'm looking to do. My buying power was close and my profit was pretty close. I mean, they're not going to be the same every time when you have volatility up and down. But I think that's a pretty good oil trade there that I would consider doing that today. If I'm looking at my oil accounts, what I'm waiting for is I've got a 112 trade here. This one's getting close to 95%. We're not there yet, but this one's in good shape. If I'm looking here, I got a strangle sitting at 49%. I couldn't get it to close today at 41, but we're 1 cent away from that strangle. Got a ratio spread that's up 16% in 7 days. Got another 112 here that's just percolating along nicely. This is pretty much a similar setup. $1.50 when I looked at this particular oil trade here, you were getting 34 cents on it. This one was $1.50. It was a pretty hefty trade on it. And then here I've got another strangle at 23% in 10 days. So I'm thinking some stuff on oil is going to come off. My buying power is pretty close here. You always got to update this stupid thing. So you can see my buying power is at 60, including my bill. So I'm really sitting at 50. Technically should not put any more trades on right now. So I'm okay with that. So I'm not gonna place the trade, even though I kind of would like to do that. Right now, I think we could potentially get a trade on, but I'm okay in here with what I'm doing overall. So I think your trade's is not bad. I mean, I think that trade, well, it was back in a different expiration. So I think I got rid of it. But that trade was fine. It totally fits the profile of what I would be looking to do on this particular trade at this point in time. So I think that CL trade's a good one. Let's take a quick look at chat here. Yeah, although I want to put a trade on. I'm sitting at 50%. I mean, 50% is not, it's not over 50, right? Well, I guess it's technically 50.2. So I think that's one thing. The other thing we were looking at here is I have 2 112 PDSs that are expiring today. So these I've already posted that these will expire worthless today. Totally fine. Those are going to be gone. It's going to leave me, not going to leave me short-handed, but it's going to leave me with a long put from an old 112 put debit spread. It's going to leave me with a long hedge put here. It's going to leave me with another long put here. And it's going to leave me with some BA trades that are kind of pretty much hedge worthy here, and then a few other trades that are not ready to expire. Now, this one here, I'm pretty doggone close at 93%. I'm pretty doggone close to taking this naked put off. So I'm not gonna close it. Tom, yep, totally. Yeah, just DM me on that. And so I'm not going to close anything here, but what I'd like to get going is maybe another safe type of a hedge type of trade in here. And I do like the trade Andy came up with. I think there's versions of it for different people based on what you want. I think that's pretty cool. But one of the things I do like is I like the opportunity to potentially trade something that's got a put debit spread that's up around the 40 delta mark or something along those lines. So can I still go to the 5 delta, sell 2 of those? Okay, this is not giving me hardly anything right now on ES, but can we make something work that's pretty much along the lines of a BA112? So that's what this is essentially a BA112. Now, why is my 4869? All right, so kind of funky here that it's showing me that we're at 49.25 and we're really not for that expiration. Okay, so this would be the trade potentially for me today if I was looking to do something like this. And now Andy puts on the two naked puts down here, and that's great depending on your size account, or the one naked put, long put down here to alleviate some of the buying power. But overall, it's not a bad trade. One of the things that I like with doing something along the lines, now this is only 60 days, which is not as advantageous for this style trade. But are you looking for the income in the tail up here? Well, what's the income on that? Well, 290 bucks on $8,000 in margin is 3.6% in 56 days. So it's really like a 1.7% return, which is, again, not the worst thing. This is a spec trade. Okay. What's my goal on a spec trade? Okay. I'd like to achieve somewhere around $1,000 a month on spec trades overall. But technically they're just spec trades. And if I don't need this income, this is a pretty nice looking trap here. I like the fact that I can only drop a few points and I'm in the trap early. Now, again, and this is a $2,800 trap on this particular one. If you want to lengthen this out, and I kind of like the 90 DTE versions of something along these lines. This 90 DTE is pretty nice when I'm looking at it. So I'm still going to stay with 50 wide here. I can probably drop this down a bit. Let's just go here and see what it looks like. I like the 90 DTE version of this because my buying power is going to be significantly less the farther out I go. I know a 90 DTE trade. If I was trading a strangle on 90 DTE, okay, I'd be using a 7 delta on the lower end. I'm using 6 here. We could actually go up a little higher for this. Yeah, I know it's the different expirations or different futures contracts. On this particular contract here, right, I'm looking at, 750 bucks in the tail, which is 10%. And if you figure in a 90 DTE trade that this would come off in roughly 75% of the time, okay, what's 75% of 90 is like 67 days. Let's just say it takes 30 days for this to come off, okay, to close these naked puts down here. If it takes 30 days to come off, I'm making 10% on this particular account. That's pretty good. So 10% in 60 days is way more than I'm looking for. So that's a pretty nice little hedge type of trade. I think you can do a couple different things here. I think you have a little bit of cash to play with. I might widen this a little bit more. That's too wide. But something like this, that's like 75 wide up here. We're doggone close to this trap. It's flattened it out a bit. If I look at this, I brought the line up just a bit. So 75 wide, I've got a pretty big juicy trap. Okay, I can go, this is only a 1% lift. If we close at a $4,000 loss, we'd have to come all the way down to about here to hit the loss on this particular trade. Okay, so we'd have to drop to about 4,200 for me to stop out of this trade currently, unless, and that's just using Tasty, which is not always the best yet. All right, so this is a pretty nice trade. I like the fact that the PDS is high. I think I could even go 75 wide. I'm getting 400. Let's lock this thing in because I'm sick of it moving around. Let's look at this particular trade. So this is kind of taking Andy's trade a bit. My stop losses on now Andy's trade's he's got his own stops. Mine would be, what's a 2x loss on your naked put? There's 2 naked puts, and that's probably what the first stop would be. Or you could potentially look at a 1x trap loss on this thing, which would be fine as well, which gives me a lot of room to work. But I can make $438 on this in the tail, and I'm only using $6,900. I could add the other put. Okay, this is a 6% trade. Okay, 6.3%. If you assume that this is going to probably close potentially in 27 to 30 days, then you will make essentially your 3.1% a month. But that's on the tail. You now have here, really around 40 delta, you have yourself a pretty good chance that this thing is going in. If I remove this, okay, 4,200. I mean, you got a 40% probability of profit of getting into this trap. That's not bad. Okay, and I mean, you can easily tell from your delta what it's going to be, but that's a pretty good opportunity, I think, here to put on a trade that gives you a 40% chance of making $4,000 versus a 60% chance. So a 60% chance to make 3% or $400 and a 40% chance to make $4,000 on this particular trade. Okay. I kind of like it. So I do like this trade. And I think this is a good opportunity trade. I think I might want to put this on here. If I was putting a trade on, I want to try to get more of this. This is kind of a combination between an BA112, the fat trade, which is more than 50 wide, which is not quite 100. It's it's a little bit of a version of Andy's trade where the put debit spread's higher, and it's kind of a BA trade where you have a longer runway here, even though you're not really getting down this deep into it. I think you can still do pretty good. Even if you didn't care about making any money here, would you want to put something like this on, which is even more of a version of a BA trade, an FB trade, an Andy trade, and I still have a 40% chance to make almost $4,000, and I'm not even worried about this thing until it gets down to 4,100. So I kind of like this particular trade. I think this is something to consider putting on so would you do this trade? Okay. Right now, markets are not overextended. You're on a bullish run, and you just breached a new all-time high on the S&P today. So I think this is not a bad trade to put on. 1425 down here. And then I could size it. I don't even need to do multiples of this. You could also try to put on a 111 version of this thing. Problem is with the 111, in order to get any kind of a credit on this trade, okay, you have to fuss around a bit more. Okay, so here's also not a bad trade. So here's a 111 version that you're not as far away, but you're using a lot, you're using less buying power. You just got to make the decision for yourself what you guys want to do with the trade. I think I'm good. Oops. I think I'm good with putting something along this line on in here, where I have a pretty long trap. It's pretty fat. It's 75 wide. I can make some cash up in here. Okay. And maybe we start to drop the buying power a bit on this thing. Was 4,100 where I had it before? I don't even remember. Yeah, well, it was a little lower than what I had before. Okay, this is not a bad trade. Yeah, I moved it to 50 wide. The 50 wide is not too bad in here. So you're making $458 on $6,100. This is a 7.5% trade that could come off in 70 days or 60 days. Let's just say it takes longer and it takes 60 days to come off. You have a pretty fat trap. Okay. If if you did the 75 wide, the credit would be 340. So do you want a little bit more tail credit at 7%? Okay, or are we really playing for the trap here? Okay, what if we moved it all the way up? Okay, and then what if we put that, what if we just went right at the strike and we put this thing on? Now you're talking essentially a 50 50 shot of landing in the trap. But I think that's a little wide or a little too high, and but I do like going higher on these particular trades and looking to do something that makes you some decent money along the way. Okay, let's move to 4150. This trade looks pretty nice as well. I can do 50 wide, still make 3 grand in here, which was kind of what I was making. I was making 4 grand before. I still have a 40% chance of dropping in the trap. I do like this trade quite a bit. And I like the fact that I could still make decent money up in here. And we still would have to drop significantly, 700 points, before this thing gets stopped, gets either called away or closed. So that's not bad. So I think I put this trade on 4150 at 1275. Okay. All right, we're going to put this on. All right. Yeah, just got filled on I got filled on something completely different. Okay, so I just got filled in a bunch of things. So let's take a quick look what we got going on. Hey, we just got filled. So there's a little 0 DTE trade on the day. Now, there's the nice things about what happened. So what's happened to my buying power since we've been talking? Okay, the reason I was pretty, what am I doing there? I can never trust this thing. Okay, my buying power is back down to 54, which is technically 44, because why? I just closed a gold naked put. So I just closed the gold naked put that was sitting out there. I had a 95% order in, so this just took off the G4. Okay, totally closed it out. I already closed the naked put or the put debit spread for a profit. Now now the naked put is totally gone. It just closed while we were talking. It freed up enough BP for me to then go ahead and put this particular trade on. All right, so now I have this trade that we just put on, which is pretty much a version of Andy's trade. So, but it's kind of a version of the BA112, the FB112, Andy's trade, whatever. They're all here. Does this make sense for everybody if you're watching? What I'm looking for, I'm giving it. I'll call it an AT112 for now, just because of the structure. This is what I put on. Okay. And I still love my structure here. I mean, this thing is nice right now where we are. Okay, so this is the trade I just put on just now, right? Pretty nice trade. Still gives me a good chunk of space up here. Gives me all the way down to 4180 down here, which is kind of a standard 112. It's at 90 days. I went a little longer, but I really want to try to put something on that's going to get me on any kind of a down move, get me into this trap, and let me start, let me start working at it. Okay. So, yep, portfolio looks like a tank. Hopefully it is a tank. So that's the goal here on the position. So we still have buying power left. Not that you have to go run out and spend it today. And these strangles on copper have just been killing it. We've been closing them for 30% in 10 days. This one's now 20% in 3 days. Okay, it's just killing it. So I'm going to just keep riding these as long as I can, and we're just going to keep taking money in. It's kind of like that zero DTE. Hey, if you can put some on and generate yourself $250 a day on days when you feel like doing it, that's pretty good. I also like where we are here on bonds. I think bonds are setting themselves up for some 112s as well. All right. I think that's a long time for everybody. This is like an hour and a half for you guys. My voice is going to be fried, even though Igor did most of the talking on this. I hope this helps. Again, I think the key to what Igor is doing is you've got to have, I think, substantial size of an account to go to PM without causing yourself some problems. You have to decide what your vehicle is going to be. I don't care what your size account is, but do you want to trade a 112? Can you do it? What size vehicle? Is it an MES, an ES, SPX, or something else that you would have put on? And then if you do that, what sizing? What do you want to use of those trades? How many can you put on a month? Just really start to mess around with what's going to work for you, and take what we got and play with it. All right, that's probably good enough for today. We just put on a trade, so we got another one of these unique version trades. This is a 90 DTE version of. I'll use the AT moniker here until we come up with something on it. I'm not going to take any of these stuff here and run with it, but we did put his trade on as well. Markets are hitting new all-time highs in here. I want to have a little bit more of that protection on, which is why I did that particular trade. Is it gives me a little bit of protection, even though I have naked puts, which don't give me protection. The last thing I wanted to take a look at here was, okay, this is the next trade that's coming up, and I am going to close the naked puts here at 95 or at 93, 90. But now I'm not going to do it at 93. I'm going to wait till 95. Okay, but I am going to continue to keep closing these short puts at roughly around 97%. So when the short put of the PDS gets to about 97, that's when I'll probably take this thing off, somewhere around the $200 mark. So for $200, I'm going to get another 400 or another 4,000 strike 2 naked puts. I'm going to keep adding those on, so that I'm starting to stack up long puts. Okay, so long puts for protection, and as you take those trades off, and if you really want to pay for those, then move your strikes up 1 to like a 6 delta from a 5. All right, I think that's good enough for today, gang. We'll leave it there, and we'll see you guys in the Discord. Thanks, everybody.